Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello everyone, my name is Zhong and welcome to Through the Noise podcast. In the past week, the single most significant data is arguably the hotter than expected US inflation. It has raised doubts about the disinflation theme, pushing back Fed rates cuts expectation. Naturally, one would ask, how to access the latest inflation report and what are the implications? To discuss this and more, I've invited Audrey, our head of asset allocation here at the CIO office. Welcome, Audrey. Let's tackle the question I raised in the intro in parts. Firstly, how do our listeners read the latest inflation print?
Well, the hotter than expected inflation clearly and certainly raised doubts among investors whether we can eventually achieve a US soft landing. So if you look at the data, core inflation accelerated by 0.4% month on month, which is more than twice the rate needed to bring annualized inflation back towards the Fed's 2% target. And if you look at core service sector inflation, that one looks to be stickier than its goods counterpart, which is now in outright deflation territory. While shelter costs, which is the main driver of service sector inflation, is likely to cool gradually, as seen through forward-looking asking rents, but other components such as medical care, for example, certainly continue to pose a challenge to this inflation. So if you look at core service inflation, excluding shelter, which the Fed is especially concerned about, that basically rose 0.7% month on month in January, which is the strongest since 2022. And following the inflation report as well, we've also seen the markets dial back on expectations of a Fed rate cut and is now expecting the first cut in June, which has been our base case since the start of the year. However, there are also signs of emerging weakness, which we expect to eventually weigh on inflation later this year as well. So if you look at the US retail sales report, that was much softer than expected. Controlled group retail sales, which is a more precise measure of consumption, contracted 0.4% month on month. And some of the weakness can be ascribed to a moderation in sales following a very strong, robust December holiday spending season, falling goods prices, as well as bad weather. So nevertheless, slowing consumption data thus corroborates with the weakness that we saw in the labor market, which should eventually weigh on inflation this year and therefore helping the economy soft land.
Okay, so it sounds like there are elements of the inflation report that needs to be watched closely, but there are also signs of emerging weakness which we expect to eventually weigh on inflation later this year. So what are the investment implications? Maybe let's start from global equities.
So within global equities, we remain overweight on the US as well as Japanese equities in our foundation portfolios. So if you look at US, in the near term, we continue to see pretty stretched investor positioning within US equities. This suggests that a pullback is still likely near term. And the catalyst for such a pullback could be due to changes in interest rate or even growth expectation. From a technical perspective, we see support for the S&P 500 at around 4,700 level, which is a level we're quite comfortable and happy to add exposure to. And then the next key support will be at the 4,550 levels as well. And then within US itself, if we talk about sectors, our preference continue to lean towards technology, communication services, as well as healthcare, where we expect strong earnings growth in 2024 to drive our performance. Now, if we look at Japanese equities, over here, the momentum continues to be pretty upbeat, with the Nikkei hitting a 3-decade high. So while a short-term pullback can certainly, not be ruled out, it is an area that we continue to like given expected fundamentals improvement. So if we look earlier this year, the Tokyo Stock Exchange published an overview of corporate disclosures with plans to boost cost of capital as well as stock prices. And as a result of that, more than half of the prime market companies issued some form of disclosure as of December last year, which was up significantly up significantly from 31% in July 2023. And corporates themselves are also undertaking share buybacks proactively as well. in addition to media reports, which are also suggesting reduced cross holding in terms of shares by major insurance in Japan. And we expect these initiatives to help to promote better governance and really focus the corporate's attention towards maximizing profitability as well as shareholders' value. From a technical perspective, our diversity indicator continues to suggest that positioning in Japanese equities is still not too stretched yet, while a potential strengthening in yen may present some headwinds to corporate earnings and limit the prospects of near-term significant upside in the market. We do believe that Japanese equities could outperform over a 6 to 12 months horizon based on the above factors I mentioned earlier.
Let's move to bonds, right? What are the implications from the latest data that would affect, I guess, the bond universe?
So after the US inflation report, we have seen market pushing back expectations of first rate cut to June, and the extent of rate cuts have also been reduced from 5 to 6 rate cuts to about 4 rate cuts, which is about 100 basis point. And against that backdrop, we've also seen the US 10-year Treasury bond yield rebounded above 4.25%, which provides a potential opportunity for investors to average into DM government bonds at a higher yield level. While we have certainly seen pretty strong set of US data recently, the leading indicators that we monitor continue to point towards slower growth over the course of 2024, and which we believe supports our view of a first rate cut in June and henceforth lower yields as well over the next 12 months. From a technical perspective, we see the 10-year yield as consolidating around 4.25% after testing a key resistance level at about 4.3%. So if this resistance level were to break, then we could well see the 10-year US 10-year Treasury bond yield testing the 4.55% level. Hence, it will be quite important to monitor key economic data over the coming week. But that said, investors' positioning in the rates market now looks less stretched, and the risk-reward balance has also turned to be a bit more attractive to add to developed market sovereign bonds.
Let's end off with currencies. What are some implications from the latest data for the different FX pairs?
So the markets is now pricing in a slightly less dovish Fed and a stronger US dollar. The key question is whether this sustains the US exceptionalism theme. From our viewpoint, the dollar index or the DXY appears to be in consolidation after rising to its highest level since mid-November. So in the near term, we see limited risk of further upside, and therefore we would also refrain from adding exposure to US dollar. The stronger greenback we've seen recently have also, pushed the US JPY or dollar yen pair to over 150 at one point, which basically prompted Japanese central bank officials to verbally intervene by stating that they stood ready to step into the market if needed to curb rapid moves in the JPY. So, besides intervention risk from the BOJ, the Bank of Japan, the pair also face downside risk from a potential rate hike by the central bank this year as well, which will likely be a tailwind for a stronger yen as well. So I think in the near term, technicals suggest that the JPY, US dollar JPY looks overbought, and we believe further upside from here is slightly limited. The pair may first test its support at around the 50 days moving average of around 145.7. And then last but not least, in terms of Swissy, US dollar Swiss franc, this pair has basically edged higher since the start of the year on the back of stronger US data as well as pretty benign inflation in Switzerland, which basically raised expectations of a dovish swift shift by the Swiss central bank. So in the near term, we expect US dollar Swiss franc to be largely range bound with a slight bearish bias on the back of some partial profit taking and also technicals looking rather overbought at this point in time. So we see the 0.8950 as a key resistance level, while the pair is likely to test its support around the 50-day moving average, which is at around 0.8620.
Thanks for all the wonderful insights, Audrey. To sum it all up, while the recent US economic activity indicators have been mostly resilient, there are also signs of emerging weakness which we expect to eventually weigh on inflation later this year. The latest US data supports one of our core investment team, firstly, which is to maintain an overweight to global equities with a preference for US and Japan, given the continued resilience in economic activities and corporate earnings. Then second is to remain overweight on developed markets government bonds to capture the high yields on offer. That would about wrap it up for this week's podcast. Thank you so much for listening from start to end. Have a wonderful weekend. Cheers.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.